Financial planning actually sounds very difficult, but it is really not a rocket science, because if you implement 7 simple personal finance rules to your life, these rules have incorporated in simple maths that can help you amass wealth and attain financial freedom. To discuss all of this, we have Shweta Jain of Investography. Shweta, thank you so much for joining us today on ET Now. I'm really looking forward to this interesting conversation, because here we're going to tell our viewers about those simple math techniques that they can actually implement in their financial decisions. But firstly, how to go about allocation of money, because whenever we receive a salary or a business payment, what should be my allocation, because it's a difficult task. How much should I save? How much should I allocate for my expenses? Is there any rule to help us?
Srishti, thanks for having me. So there is a rule that you can follow. It's a 50-30-20 rule. 50 towards your needs, 30 towards your wants, and 20 towards savings. So that's the popular rule. So if you could save 100% of it. That's fantastic. But the 50-30-20 rule sort of works for most people. Even in India, historically, if you see our parents, grandparents, they had pretty much a 30% savings ratio. If you see research also, they would save 30% of their income. And today we're talking about the 50-30-20 rule, which is 20% of our income, which is still good. Um, uh, we could push that to 30, but I think a 50-30-20 is a damn good rule to start off with.
Okay, like 20% of the savings. So, first step is to actually save, and then we can look into how should we invest that money and make that grow. But is there any rule which can help us with our cost side? Like, how should we planning our cost structure so that going forward it is not a burden on us?
When we're looking at costs, we're looking at inflation where our costs are regularly increasing periodically, sometimes increasing even without us knowing, especially if you're like most people and you're not budgeting. So I think that 50% needs is pretty much something that you can follow. And inflation is something that you should track, not just the inflation that is shown on record or talked about, but the inflation that you have. So there are two types of inflation. One is on your needs and one is on your lifestyle. So I think inflation is something that you should track, and that is on your own budget. So have your spreadsheets, have your notebooks, wherever you do your budgeting, do that readily. And you will make sure that you're sticking to your budget and then allocating investments accordingly. We're usually so hung up on the 20% of the money of the savings that 80% of it is something that we're ignoring. I think having a splurging budget helps so that we don't go beyond that 25-30 magical number. Because unlike previous generations, our generation wants to live in the today as well, which isn't wrong. But that just means it brings its own challenges. So I really like the 50-30-20 rule, but I want to make sure that we're sticking to it. So, which is why budgeting becomes really important, inflation becomes important. Healthcare inflation is higher, it's at about 10%. Education inflation is higher, it's about 10%. Regular inflation might be lesser, but these inflation is higher. And these are things that we don't even realize, that go out of our pocket unless we're committing to that 20% saving. So I think automated savings is something that, as a hack, I generally recommend people that 20% of the income shouldn't even come to us. It should just directly go to our investments. So be it mutual funds, be it other products. So I think that is something that people should do. Otherwise, we're going to end up spending pretty much 100% of the money.
Shweta, I would really like to touch upon how should we grow the 20% of our savings, but sticking to the cost structure for now, because when we are talking about costs, is not just the spending on the day-to-day activities. We have some planned cost as well. When I'm looking to have EMIs for same, is there any help there? How should I plan my EMIs on an overall basis? Like, what kind of allocation can I look forward for this particular cost? And apart from that, what's the breakup that I can spend on my day-to-day activities or on my some planned holidays is per se?
the EMIs, 40% of your income is something that, as a rule, we recommend that they follow so that you don't overstretch yourself, over leverage yourself. So, for 40% of your income could be your EMI. More than that, then there is trouble brewing, because in case of any sudden goals, in case of any emergencies, in case of loss of job, etc., etc., because life is uncertain, so you could encounter some of these. So it gets really difficult. But 40% of your income could be your EMI. This is something that we recommend that, as a rule, you follow, not more than 40%. Down payment of a house, for example, 80-20 rule is the rule that we recommend. So 80% could be your loan, 20% has to be your down payment, not less than 20%. A lot of projects do take lesser than 20%, but that's something that we really recommend people follow. Otherwise, you'll end up um, investing in assets that you may not be able to afford further on as well, or even today. You might push yourself to a limit where you get stuck. So that is something that you should follow. In terms of future goals, we're looking at, say, investments that could grow. And I think a number or a rule that people should really look at is the rule of 72. That's something that people can start looking at if they haven't heard of this. It's a very popular rule. So it says basically how soon can you double your money. So Indians do like to talk about doubling money. So we talk about the rule of 72, where you divide the interest that you're earning. So whether it's FDs, whether it's equities, what returns you could make. So you divide that by 72. Say, for example, it's 6%. So how long will this take for you to double your money? So say if the FD was giving you 6%, it'll take about 12 years for you to double your money, 72 divided by 6. Or say if you were to invest in an asset which was giving you 12%, say for example, equities, then you will divide 72 by 12 and say, okay, so this money could double prospectively in 6 years. So that is how you sort of work on your numbers and see, okay, this is what I'm looking at, and whether it's to create wealth, whether it's for a future goal, be it vacations, be it your kids' education, be it any goal for that matter, you could invest regularly, so that in given that returns, your money will say double. So the rule of 72 is a good rule to follow.
Yes, absolutely. And that's a very interesting rule. I'm sure everybody wants to double their money. But Shweta, in this segment, we are trying to break down the rules of personal finance in the simplest manner. What kind of a return expectation should a person be having? Because whenever they are going for these calculations, you mentioned about a lot of instruments, be it from direct equity investment to mutual funds. Whenever they are sitting down and trying to work upon this particular rule, on an average, what kind of return expectation they can have from various instruments? Any take on this?
So return expectations varies from period to period, but I would say, for example, if you were to look at just your EPF, right? So you get an 8% plus on your EPF. So that's you know how much you're going to get. So you know how much time your money could double. If you're looking at debt products, whether it's FDs, whether it's debt mutual funds, you could look at about 6 to 7% returns at the moment. You could look at 12 to 15% in equities, whether it's direct equity, whether it's large cap, small cap, depending on the kind. But the minimum time horizon there would be at least 5 years, I would think. So it won't be linear. That is something that investors have to understand. But over time, over say 5 year period, you can expect a 10 to 15, ideally, that you could look at. And to keep long-term horizon is something in equity that can really pay off. And if there's one concept that I think schools should pay more attention to, and we as students should pay more attention to, is compound interest. I think that's something that is valuable, and people can look at compound interest as a concept when they're looking at investing.
Shweta, but like you were mentioning, equities. So, a lot of retail investors are coming up with their interest in equities, and people surely want to double their money in equities, and that too in short run. That's a risky affair. But is there any rule to help me with, like, the savings that I have? How much of it should I actually risk into equities? I'm not saying that it is purely equity, it is purely risky, but in compared to the other instruments, like for debt, say matter, or PFs, equities is seen to be risky and people tend to lose a lot of money. So, is there any guidance on this front?
There is a thumb rule which says 100 minus your age should be your exposure to equity. I don't really like this rule because, say, I'm 30 years old. I'm not, but say I'm 30 years old. 100 minus 30, so 70 should be in equity. But what if I have all my goals in the next, say, 3 years? Then what happens to all of that money? I'm taking a huge risk there. So while this is again a very popular thumb rule, and I get this question a lot, saying because I'm young, should I be over invested in equity, or I should I have like 80% of my portfolio in equity? It isn't like that. You should have your goals set. You should know what kind of goals that you have, what is the time horizon, and that is how you can commit to equity for a longer time horizon.
Shweta, we will not see you as 30 years, though you do look like a girl, but we can see that baby around and hear his voice. But moving forward to our next question, what's the rule on withdrawing? Because I can only look for investing. Definitely, that's a positive outlook that I'm having. But in case of emergencies as well, how much money should I actually withdraw, or not just in emergencies, even if I want to travel somewhere, if I have some planned event of my life, then what's the strategy there?
So I will talk about both the emergency and the long-term planned withdrawal. So emergency rule is that 3 to 6 months of your expenses you should have in an emergency fund and have it available liquid in no risk investments. So that is something that you should definitely have. There is a rule of 4% for retirement money. So basically, the rule says that if you have a corpus and you withdraw 4% of it every year as your requirement, you're good to go. So, say for example, somebody has a corpus of 1 crore, right? So, if your annual expenses are up to 4 lakhs, then you're good to retire. But it isn't as simple as that, right? So a number of factors come into play here. So for example, inflation comes into play. What happens post inflation, post taxes, when such calculators are just given generically, it's not necessarily that it will apply to you. You have to apply your life situation. So what kind of goals do you have post retirement? So this money could just be enough for your retirement, for example, but it may not take into account other goals that may come, whether it's kids education, marriage, or your own vacations, etc. It also doesn't account for the fact that you may retire at 40 or you are retiring at 60. So when you read about the 4% in play rule of retirement, you just see that, okay, if I have this much money, I'm good. But if you read further, it says for up to 30 years, right? So what happens if you retire at 40 and then the corpus is over at, say, 70? What happens then at 70? Are you going to go back to work? Unlikely, right? So I usually talk to clients about this, and we talk about how retirement corpus has to be much, much bigger than what calculators are giving you, because some of the things that they don't account for is the human tendency to spend more as you have more time, right? So some of these things is something that we don't account for. Taxes, inflation, which are out of our control, are things that we are not accounting for as well, because these are not something that can be under our control. Healthcare expenses, for that matter, are also not under our control. And with the kind of costs that we are seeing just in healthcare, and extension of lifespan is something that we can see that also happening. And so these are things that we need to account for in our retirement planning. So the 4% rule doesn't really talk about it like that.
Absolutely, and Shweta, with this, we are out of time, but this was a pleasure having you on 18 Now, and thank you for sharing these 7 golden rules on the personal finance, how the basic maths can actually help you plan your future.